To understand why stablecoins matter, it is important to understand how fundamentally different they are from assets like Bitcoin and Ether. Most digital assets are designed to fluctuate in price. Bitcoin is a scarce, decentralized asset optimized for long-term value preservation and censorship resistance. Ethereum functions as a programmable settlement layer, with value accruing to the Ether token through innovation. Volatility isn't a flaw in these systems, it's part of price discovery. Stablecoins are designed to do the opposite. The defining feature of a stablecoin is price stability. Instead of floating freely, stablecoins are typically pegged to a reference asset, most often the US dollar, and rely on reserves, collateral, or stabilization mechanisms designed to keep their value anchored around $1. This difference in design leads to a difference in function. While Bitcoin and Ether are primarily investment or network assets, stablecoins are transactional. They're built for payments, settlement, and liquidity, not speculation. Stablecoins allow users to move value on-chain while minimizing exposure to volatility, making them useful for trading, remittances, payroll, and cross-border commerce. Another key distinction is who uses them and why. Investors generally hold Bitcoin and Ether for long-term appreciation or network exposure, while businesses and individuals use stablecoins for cash-like utility, to park capital, settle trades, and move dollars globally and instantly. Stablecoins also tend to behave differently in market cycles. During volatile periods, capital often flows into stablecoins rather than exiting the digital asset ecosystem, making them a central source of on-chain liquidity across both risk-on and risk-off environments. Importantly, stablecoins don't compete with Bitcoin or Ether. They enable them. By providing a stable unit of account, stablecoins make it easier for volatile assets to trade, scale, and integrate with real-world financial activity. In short, Bitcoin and Ether represent ownership and innovation, while stablecoins focus on utility and stability. Together, they form a complementary system, one built for value creation and the other built for value movement. Stablecoins aren't trying to be the next Bitcoin. They're aiming to be the digital dollar that makes the entire ecosystem usable.